We just finished the financial management functions. We're talking about the financial management objectives, non-financial objectives, agency problem, not-for-profit organizations, for example, by using the value for money, how the 3 E's to achieve the value for money. And then we move next to talk about financial management environment. We talk about 3 key topics: economic policy objectives, financial intermediaries, and financial markets. First, the economic policy and objectives. And before going into any details, we need to explain what is economic policy or the macroeconomic policy. The macroeconomic policy can affect planning and decision-making in various ways. For example, by interest rate changes, which affects borrowing costs and required rates of returns. And remember, for the economic policy, we talk about the government. Okay, who set the policy is the government. So what's the policy objectives? It's the government objectives. So we talk about how the government affect your business here. We'll talk about financial management environment. First topic, we talk about economic policy, which means how the government policy affect your business. So you have to define the policy objectives is the government objectives, including economic growth. If the government set a target, say the economic growth, like the GDP growth, is 6%, is the national policy, then the steps or the policy will just aim at 6% GDP growth. They have, for example, a lot of different government projects to be on the way and a lot of different measures to push the economic growth in order to achieve 6%. Then if your company is involved in the related business, then your company will be, for example, benefits from it. If not, then you have to think about whether how to improve or how to increase your shareholders' value by, say, enjoying some government policy or some benefits from the government policy. Control the price inflation. Okay, it's sometimes because inflation is a big issue for some governments. If the inflation is very, very high, hyperinflation, we talk hyperinflation, we talk not about 10% inflation rate. We talk about maybe per year, the inflation rate is 100%, 100%, or even higher than 400%. It's hyperinflation. If hyperinflation, the government need to stop it. Otherwise, the people or the citizens of the country will be very angry because they cannot keep cash. Once they keep cash, maybe just 2 or 3 months later, the value of the cash depreciate a lot. They cannot buy the same quantity of things as compared to, say, 2 or 3 months ago. So the price control or the control price inflation is the very important for some countries if they are facing hyperinflation. If some countries say, or in the opposite way is deflation, is also an issue. Deflation means it's the opposite of inflation, maybe -5%. The price level keep dropping every year, say 5% drop in the overall price level. It means that for anybody, holding cash is the winner. If, for example, the people like to invest by borrowing, then it can be suffered because the overall price level is dropping. Then your revenue is dropping, your profit maybe is dropping as well. But however, your liability is fixed, your debt level is fixed, then you face the problem of repaying your loans. So deflation is also not good for those people who like to do the business, and discourage the people to invest as well. full employment is also the government objective to push it for the to make the people happy. By, for example, there's a jobs in the market, and people would like to if they would like to find a new jobs, and it is quite easy to get a new jobs. It's full employment, which is the government goals as well. Balance of payment stability, it means the trade. The people would like, say the government would like to have the trade balance with its major trading partners. Okay, because the balance of payment stability also means the currency is stable as well. Okay, maybe means the currency is stable. So here we talk about 4 economic policy and objectives. We need to define well. For each policy, they are different because in examination, a lot of multiple choice questions or objective test question is asking about different policy and to ask you whether you understand them well. First of all, is monetary policy. Monetary policy. What is monetary policy? Monetary policy aims to influence the monetary variables like interest rate, money supply, and these tools is to achieve employment, inflation, maybe economic growth, and balance of payments. So here, just have a quick look of it. Here is a formula. We talk about MV equal to PY. And we talk about monetary policy, we talk about the M. So what is M? M is money supply. So a lot of countries, they have the only one organization has the authority to give the money supply is the central bank. Okay, for example, Bank of England is the central bank of United Kingdom. So it has the right to issue the print money for the circulation in the market. And V is velocity. It means the money circulation in the market, whether it's fast or slow. P is the price level. So it is the indicator of inflation. And Y is the GDP, the real GDP. It means the output. So here the government, if we talk about the monetary policy, it means the government is focused on money supply, the central bank. The function is the central bank to manage the money supply in the market in order to control the price level. It means the inflation and hopefully has the impact to the output as well. But in general, it mainly focuses on the price level. And for the GDP, for the output, it is also an indicator of employment. Okay, so here is the basic formula which some people may learn it from the high school as well. So just recap it. For monetary policy is the central bank function to manage the money supply, focus on the inflation and the interest rate. Interest rate and inflation. Okay. So next, the fiscal policy. Fiscal policy involves using government spending. Using government spending, taxation, in order to influence the aggregate demand in the economy. So we need to know we talk about output or GDP. So what's the GDP components? They are consumption plus investment plus government spending plus net export, right? So here, the government spending. The government spending, if it increase the government spending, so in general, if consumption and investment and net export is the same, no difference, then the GDP or the economic growth can be improved or can be increased. So it's one of the target of the expansion fiscal policy means to increase the government spending or taxation. Okay, so one way to increase government spending to increase the output of the economy. The other way is to reduce or the reduction in tax. So reducing taxation is an incentive to push up the consumption and investment. So for fiscal policy, if say an expansion fiscal policy can be increased in government spending or reduction in taxation. If for these two items, it can help to improve the overall GDP or the economic output. Okay. So next, the exchange rate policy. If the government can, for example, manage the exchange rate, well, so is it any influence to the economic output? If you remember, just to mention this formula. Say if a country can manage or can manipulate its exchange rate. Say would like to have a depreciation in the currency. The currency depreciation. It means the currency value, say here USD and British pound. If the British government say, I would like to manage the currency against US dollars, which I would like to say to depreciate against US dollars. For example, today is $1. It's 1 British pound. Can exchange 1.4 US dollars. Say, if say I would like to depreciate the British pound to extreme. Okay, on parity, 1 British pound to 1 US dollars. So it depreciate. What's the impact to export? To export. Net export means export minus import. If the exchange rate is depreciate, then the export in general, okay, will be increase in export or decrease in import, or both happens, right? So the net export, in general, net export will be increased. Then what's the impact to Y? To total the GDP will be going up. So some governments would like to depreciate their own currency if they can manage the exchange rate. If that can help the net export, the balance of payment, even the interest rate, to have or to achieve their policy objectives by the government. So external trade policy, sometimes it is quite similar to exchange rate policy. If a economy or if the government would like to have more exports to increase their economic growth, to improve the economic growth, then they would like to depreciate their currency. And also the external trade policy, it can help, for example, some subsidies to the local production or manufacturing companies in order to encourage more domestic outputs to rise, to stimulate the domestic economy or to help them to export to the other markets. So that finally it can increase the GDP. Okay, for this formula. So next, competition policy. We talk about competition policy means the government needs to the government intervention. Okay, competition policy means the government needs to intervene the market because sometimes the market failure happens. So there are different forms of market failure. First, imperfect competition. Maybe there's only two companies in the industry. So without the competition environment, so the price is too high for consumer. Then the government say, hey, I need to intervene the market by putting some regulations in this industry because of imperfect competition. Next is social cost. Or imperfect information. Or finally, equity means is it fair? So what we talk about regulation because we have these different failures for the government to intervene the market. The government would like to save the people, like for example the social cost. Okay, it's not good for some pollution or some industry in the city because the pollution cost is too high. So they have the regulations of no industries in the city, for example, or imperfect information. Maybe some of the information are controlled by only one or two organizations. So the government would like to intervene the market by providing free information for the public. So here regulations introduced. Regulations can be defined as any form of state interference. So mean the government needs to step into the market, need to step into the industry with the operation of the free market. This could involve regulating demand, supply, price, profits, quantity, quality, entry, exit, anything that the government would like to be. So for competition policy, it's not only, for example, limit competition or encourage competition. It can be regulating the supply or demand, or even for the price, profit, or other things. Because they found there's market failure in which the free market cannot work well to the benefits of the public. And some countries have legislations which deals with restrictive practices that distort, restrict, or prevent competition. Okay, maybe government stepping in. For example, like oil and gas. In some countries, oil and gas is a restricted industry that only the government is allowed to do this business or to do this to involve in this industry. They are not encouraged any other competition because they find it is very the market failure will happen if it released to only 2 or 3 organizations to do this business. So the government would like to say, hey, I would like to prevent any competition by doing by myself for oil and gas. So we talk government assistance. Government, okay, not only limit the competition or have the competition policy, the government can also provide aids or finance to companies in cash grants and other forms of assistance as part of its policy of helping to develop the national economy, for example, like in high technology industries in areas of high unemployment. So it's the government assistance to have some objective. Say, I would like to encourage the high technology growth. So I put the resources on this, I put the grants or assistance on this area, or in some area with high unemployment. Okay, so government would like to put the resources on those areas with high unemployment to encourage the people or to encourage the organizations to set up their offices or their factories in these areas to hire the people there. It depends. It can be divided as the regional basis or selective national basis. It means here is the industry, maybe. Green policy is a government policy because for green policy, it is seldom the private sector or for-profit organization objective. It is the government objectives. The problems of pollution will affect the people's health. So the government would like to have the environmental protection policy or green policy to call for international cooperations between governments. And another policy is about the corporate governance regulations. It's about how to improve the organization's corporate governance. Guidance can be issued or given because of lack of confidence perceived in financial reporting and in the ability of auditors to provide assurance required by the users of financial accounts. It means that the organization's financial statements, even they are audited, but they are not trusted by the users because of their lack of transparency. And corporate governance. Say, hey, because of some ethical issues or some a lot of accounts, the numbers are not truly reflected. Even they are audited because the auditing standard is not cannot meet the international standard, for example. So the government would like to improve those governance regulations in order to improve the confidence in the public investor in public markets, to improve the investors' impression as well, because it can help the investors to invest in the country. So don't forget, if you would like to have economic growth, government expenditure and the net export is not enough. Investment is also very crucial if you like to improve or increase your economic growth. Okay.